But I want to focus our attention on the moves that we are seeing play out in the oil space. Right now, crude back above $40 a barrel and only about 15% off of the levels we saw back in February. But the question becomes, what upside might be limited here as we, again, keep in track the ongoing changes here on the supply front as rigs continue to fall here in the U.S. And for more on that, I want to bring on our next guest. Tom Kloza is OPIS Global Head of Energy Analysis, and he joins us now on the phone. And Mr. Kloza, appreciate you taking the time to chat here. I just want to start by getting your take on a lot of the flux that we've seen here. As again, Baker Hughes, the rig count there that we got last week showing that we're down to the lowest rig count since 2009. So what's your take on maybe how supply might be coming to meet demand back in normal long run scenarios here?
Well, I tend to underemphasize the rig count. And I mean, I do think U.S. production is dropping, particularly in some of the shale plays with, maybe a third or half of the shale underwater, so to speak, in terms of the balance sheet. But there still is an awful lot of crude oil and refined products around. The global overhang that accumulated in the second quarter is just unprecedented. And you have to remember that we saw demand numbers for April of this year for gasoline that were the equivalent of what we used maybe in 1968 or 1969. We've come back from that, but refined products have to move up, and you have to get a rebalancing of economies to really, really send crude oil higher. I like crude oil in 2021. I don't necessarily like it as it moves above $40 here for the rest of the year.
I guess that's a pretty good, important statistic to highlight there when you think about how severe the demand shock was here in the U.S., but also around the globe. And when you think about it, I mean, supply cuts haven't been nearly as drastic globally, I guess, when we think about what OPEC Plus did, though it was a bit of a bullish move there for oil. But what's your take on maybe what happens in the back half of 2020 as maybe demand, as you're saying here, doesn't necessarily come back from, the trough of what we saw?
I think we're in trouble for the back half of 2020 in terms of refining margins and in terms of moving traditional products like jet fuel, gasoline, and diesel. I mean, if you're not seeing the school buses on the road in another couple of months, and you're not seeing the coach buses, and you're not seeing the mass transit and the 18-wheelers on the road kind of concluding supply chains, it's going to spell trouble. The OPEC adherence to quotas is probably going to be fairly solid, but they have so much spare capacity now, and spare capacity can really rear its head at any point if some of the weaker sort of disciplined members of OPEC, Nigeria, Iraq, or whatever, kind of fall off the wagon. So, there's an investment bank out there talking $150 to $190 oil eventually in the next couple of years. That's possible, but it's also possible that Penelope Cruz and Scarlett Johansson will have me over for a barbecue that maybe Padma Lakshmi from Top Chef will be supervising.
Yeah, well, I'll allow you to come over to my barbecues. I think that's a much easier invite to get here. But when we look at it, I mean, July does start to seem like one of those very important turning points for what we could see in 2020. Not just because globally, here in the U.S. when we talk about the economic stimulus here and unemployment benefits rolling off there in the month of July. Also, the timeline to watch for OPEC Plus cuts, the cuts you're talking about there. And you say adherence might be strong, but what about the propensity to extend cuts even further when we see potentially, I assume, U.S. producers, shale producers, maybe turning the spigot back on if prices were to stay here at 40?
Yeah, I think if prices go between 40 and 50, we'll see some hedging, and we will see a ramp higher in shale. It's not quite as slow, much a slow poke as, let's say, offshore oil production in the big fields. It's a little bit more agile than that, but we could see production go up. It's really not about the U.S., though. The U.S. has probably seen the highest gasoline demand we'll ever see, and perhaps the highest jet fuel demand we'll see for half a decade or more. It's about the rest of the world and the developing countries. I mean, at some point, we hit 100 million barrels a day of demand early in the year or late last year, and we'll get back there. But we won't get back to the numbers that we achieved in the United States or North America. So it'll have to do with an awful lot of indigent or people on the margins of society moving into the middle class and needing fuel for transportation. And I think that's a few years away.
All right, there you go. The latest on the oil market from Tom Kloza, OPIS Global Head of Energy Analysis. Appreciate you taking the time to chat with us.